Areas don't make opportunities, brains make opportunities, basically. I think it's a mistake to shrink the universe of possibilities. Ours is shrunk simply by size, but we don't set out to circumscribe our actions in any way. But in the end, there's no form that produces investment results. Hedge funds don't produce investment results. Private equity doesn't produce investment results. Mutual funds don't produce it. That if it was simply a matter of form, we'd all call ourselves, whatever that form happened to be. What really makes the difference is whether the person that's running it knows what their limitations are, knows where their strengths are, plays when they have the opportunity to play advantageously, and stays out when they don't see any opportunities. Charlie?
Yeah, I'd go further. I'd say averaged out, I would expect that the return per dollar per year in managed futures funds would be somewhere between lousy and negative.
And I would agree with that. Yeah. Usually those are sales tools. I mean, people find out something that will sell, and it can be, it can be bond funds at some point. It can be, but when they find something that can sell, it'll get sold to the public. It will sell till it stops selling, and that means lots of money comes in and lots of competition for a limited number of opportunities. And I think it's a mistake to get sold something on the basis that here is a great area of opportunity. You just want to soak it up. If you have those qualities you talked about, you'll see the areas as you go along. I mean, Charlie and I probably, we've made money in a lot of different ways, some of which we didn't anticipate, when we were 30 or 40 years ago. But we did have the ability to recognize some. We didn't have the ability to recognize others. But we did know when we knew what we were doing and when we didn't. And we just kept looking. We had a curiosity about things. You would know at a time like the long-term capital management crisis, for example, that there were going to be ways to make money. I mean, they were going to be out there, and all you had to do was just read and think 8 or 10 hours a day, and you were going to cover a lot of possibilities, probably a very high percentage of them good, and some of them sensational. So you can't really lay it out ahead of time. You can't have a defined roadmap, but you can have a reservoir of thinking, looking at different kinds of businesses, looking at different kinds of securities, looking at markets in different places, and you will then spot a reasonable number of things that come along. You won't spot every one of them. We've missed all kinds of things. But the biggest thing, too, is to have something in the way you're programmed so that you don't ever do anything where you can lose a lot. I mean, our best ideas have not been better than other people's best ideas, but we've never had a lot of things that pulled us way back. So we never went 2 steps forward and 1 step back. We probably went 2 steps forward and a fraction of a step back. But avoiding the catastrophes is a very important thing, and it will be important in the future. I mean, you will have your chance to participate in catastrophes. Charlie?
Yeah, and of course the place to look when you're young is in the inefficient markets. You shouldn't be trying to guess whether one drug company has a better drug pipeline than another. You want to go, when you're young, someplace that's very inefficient.
And you shouldn't be trying to guess whether the stock market is going to go up or whether long-term bonds are going to change in yield. I mean, you don't have anything going in that kind of a game. But you can have a lot going in games that very few people are playing, and maybe where they're even got their heads screwed on wrong in terms of how they're thinking about the subject. The RTC was a great example of a chance to make a lot of money. I mean, here was a seller of hundreds of billions of dollars worth of real estate where the people that were selling it had no economic interest in it, were eager to wind up the thing, and they were selling it at a terrible time when the people who had been venturesome in lending were no longer lending. The people who had been venturesome in the equity end of real estate had gotten cleaned out. So you had a great background of environment, and then you had an imbalance of intensity in terms of analyzing situations between the seller, which was the government, with a bunch of people who had no economic interest in it and were probably eager to wind up the job, and buyers on the other side who were of the generally cautious type because the more venturesome type had taken themselves out of action. And there were huge amounts of property. So you get these opportunities and you'll get more. I mean, there won't be any scarcity of opportunities in your life, although there will be days when you feel that way. Okay, let's go to the other rooms now. They've been waiting. Number 13. Volatility does not measure risk. And the problem is that the people who have written and taught about volatility do not know how to measure, or taught about risk, do not know how to measure risk. And the nice thing about beta, which is a measure of volatility, is that it's nice and mathematical and wrong in terms of measuring risk. It's a measure of volatility, but past volatility does not determine the risk of investing. I mean, actually, take it with farmland here. In 1980 or in the early 1980s, farms that sold for $2,000 an acre went to $600 an acre. I bought one of them when the banking and farm crash took place, and the beta of farms shot way up. And according to standard economic theory, market theory, I was buying a much more risky asset at $600 an acre than the same farm was at $2,000 an acre. Now, people, because farmland doesn't trade often and prices don't get recorded, they would regard that as nonsense, that my purchase at $600 an acre of the same farm that sold for $2,000 an acre a few years ago was riskier. But in stocks, because the prices jiggle around every minute, and because it lets the people who teach finance use the mathematics they've learned, they have, in effect, they would explain this away a little more technically, but they have in effect translated volatility into all kinds of past volatility in terms of all kinds of measures of risk. And it's nonsense. Risk comes from the nature of certain kinds of businesses. It can be risky to be in some businesses just by the simple economics of the type of business you're in. And it comes from not knowing what you're doing. And it is, if you understand the economics of the business in which you are engaged, and you know the people with whom you're doing business, and you know the price you pay and is sensible, you don't run any real risk. And I don't think Charlie and I, certainly at Berkshire, I don't think we've ever had a permanent loss in marketable securities that was, what, 1% maybe? Half a percent of net worth. I made a terrible mistake in buying Dexter Shoe, which cost us a significantly more than 1% of net worth, where I bought an entire business then. But I was wrong about the business. It had nothing to do with the volatility of shoe prices or leather or anything else. It just was wrong. But in terms of marketable securities, I cannot recall a case where we've lost. I mean, we've done a lot of things in securities that had a very high beta. We've done a lot of things in securities that had a low beta. It just, the whole development of volatility as a measure of risk, it's really occurred in my, and it's been very useful for people who wanted a career in teaching, but it is not, we've never found a way for it to be useful to us. Charlie?
Well, it's been amazing that both corporate finance and investment management courses, as taught in the major universities, we would argue it's at least 50% twaddle. And yet these people have very high IQs. One of the reasons we've been able to do pretty well is that we early recognized that very smart people do very dumb things, and we tried to figure out why. And we also wanted to know who, so we could avoid them. And
We will not run big risks at Berkshire. Now, we will be willing to lose, as I put in the annual report, $6 billion in a given catastrophe. But our catastrophe business, run over many years, is not risky. A roulette wheel will occasionally pay off at 35 to 1. And that sounds like you're paying out an awful lot of money compared to the amount bet on one number. But I would love to own a lot of roulette wheels. Number 3.